Welcome, YouTube family, aka homies and homettes. Welcome to another edition of the Kevin Strong Show. And in this video, we're going to talk about why so many people are living paycheck to paycheck. And for a lot of those folks, it's going to be that way for a very, very, very long time. Please make sure you stick around to the end of this video because I'm going to share something with you that I found out that 97% of the population is not doing. And it clearly explains why, in some cases, why some people are lower class, middle class, the rich, and that elite 1% that so many people talk about. This is an interesting stat. So without further ado, we're going to go ahead and jump into this information. But before we do, I'm going to humbly ask, if you have not subscribed to my channel, please do so by smashing that like button, commenting and share, because I care. We only got 12 days left in this month, and this is my month. You know what I mean by that. So if you have not subscribed, aka help a brother out. So without further ado, we're going to go ahead and jump into this video. Once again, talking about why so many people are living paycheck to paycheck. So let me go ahead and set this up here. So the title of this presentation, as you can see, is Debt for Life. And in my humble opinion, it is getting worse by the day. So let's go ahead and jump into this first slide. This is based on generation and age. So this basically takes on average everybody's debt, excluding mortgages, obviously. So this is basically consumer debt broken down based on the age group. So as you can see here, from 18 to 25, roughly $15,000 worth of debt. Millennials, 26 to 41, almost 48,000. 65 to 1980, Generation X, that encompasses yours truly, the host. We're at $60,000. So that is the biggest number of consumer debt out of any other age group. As you start to move up, 58 to 76, look at that, almost $52,000 worth of consumer debt. That's setting aside mortgage debt. On average, there's only about 30% of the population that owns a mortgage flat out free and clear. So probably there's a large majority of baby boomers that are in that bucket. They probably still have a mortgage payment that they have to make. And last but not least is 77 to 94, $40,000. That is quite a bit of money. And the reason why that is so alarming is because the majority of people in that age bracket from 77 to 94 are probably retired and on fixed income. So not only do they have a lot of consumer debt that is basically having to be paid back at a much, much higher interest rate, but they're having to do so on a fixed income while at the same time trying to fight rising inflation. Okay, so here is something based on personal income. It might be kind of hard to read this chart a little bit to the right, so I kind of put the verbiage of basically what it means is that the average income is approximately around $37,500 per person. That's it. And we know as well as anybody that that's just not going to cut it. It's just not keeping up with inflation. Rent, mortgages, you name it, it's just not sustainable to have a decent lifestyle if you're basically only making $37,000 a year. So in aggregate, the household median income is probably somewhere around $74,000 to $75,000. But clearly, this graph has gone up, but it has not gone up when you compare it to how fast inflation has gone up within the last 10 or 15 years. So basically something to definitely keep your eye on. Once again, we're going to also now transition and talk about the savings rate. Now, this is a savings rate chart as of December of 2022. So this is the most recent data that I was able to get for you guys. We are heading to the worst personal savings rate in history. I have some notes here. So basically all the way to the right of that chart there, as of December of 2022, the personal savings rate was at 3.4. So probably by the end of 2023, that number will be below 3. So this is really, really, really a bad setup because you see from the previous slide, people's wages are not keeping up with inflation. At the same time, they're getting tapped out. They do not have enough savings. I've talked about ad nauseum about how important an emergency fund is. Most people don't even have $500 for an emergency. So this is a recipe for financial disaster for those who have not been proactive in trying to basically put themselves in a better position. So now we're going to talk about, it's not just the middle class or the lower middle class. Inflation is hitting above average wage earners. A lot of you may not have known, but hey, now you do. 63% of Americans are living paycheck to paycheck, including nearly half that are six-figure earners. Now, I got this information from CNBC, and some of this information from this presentation comes from Yahoo Finance. But more importantly, the verbiage that stuck out to me is that nearly half of six-figure earners. It did not say nearly half of six-figure households. So I'm going to assume that based on this verbiage, these are individuals that are making $100,000 or more a year, and they are barely getting by. You see here at the bottom of the slide, it says for the majority of employed workers, the median decline in real wages when factoring in inflation is over 8.5%. So what they're basically saying with that verbiage is that when you factor in inflation, wages are actually going down. So these big raises that some of you guys are getting, it's not basically an aggregate keeping up with inflation. And as a result of that, you are losing your buying power or your purchasing power every year. Your income is not equal to or exceeds inflation. So big deal. Like I says, if you are one of them, this means your purchasing power is being severely eroded. Okay, now we're going to talk a little bit about credit card hells, what I call this. And I got this information, as you can see from the top of the presentation, called Yahoo Finance. As credit card debt hits an all-time high, we're just basically shy of $1 trillion. In the final 3 months of 2022, delinquencies among borrowers have accelerated. People are starting to default on auto loans. People are starting to default on credit card debt. HELOCs, home equity line of credit, which is basically a second mortgage that you take out from the equity that you get from your home. Those type of mortgage products are exploding because people, once again, like in 2008, are treating their homes like an ATM machine. Look to the second point here. Balances grew $61 billion, ladies and gentlemen, just in the fourth quarter alone. That is crazy. The average rate on some of this credit card debt is 20%. A lot of you are paying a hell of a lot more than that. I know those who have FICO scores well above 750 know that if you are carrying a balance, a lot of those cards are still charging you 21 or 22%. So that's for people who have stellar credit. The average credit score hasn't gone down in America, somewhere around 690 to 695. I might be off by 10 points, but that's a pretty accurate number. So I say that to say a lot of people are paying a significantly higher interest rate than the 20%. That is just the average. And you know as well as I do, as the Fed continues to fight inflation, or at least purports to do so, they're going to continue to raise interest rates. And as a result of that, things like mortgages, credit card, auto loans, things like that, they're just going to continue to go up. Excuse me. Okay, student loan death blow to the younger generation and housing as well. I've talked about this before, but this bears repeating. A lingering concern, they noted, is the end of the student loan payment pause. Okay, and I've talked about this. If the Supreme Court overturns President Joe Biden's loan forgiveness program, this younger generation, stick a fork in them. They're done. They're already tapped out. They can't afford shelter. And then you're going to sock a $300, $400, $500, or $600 student loan payment into wages that are not keeping up with inflation. These people are just going to spiral out of control. The reason why there's collateral damage in the housing market as a result of this is the following. I like to break up the housing market kind of like into three tiers. You've got your entry-level first-time home buyers. Then you've got the middle-level folks who eventually likes to sell their house to the people who had the starter homes to get their dream house. And then once the kids are out of the house, they're empty nesters and they definitely typically will sell that house to downsize. So you've got the starter home, the mid-level home, and then the top of the line home, which is your dream home, so to speak. And then once again, as the kids leave out of the house, you kind of downsize. So this is why this is collateral damage to the younger generation as it relates to that first level of getting into the housing. If you have a $300, $400, $500, $600 student loan payment that you have to resume, assume this is going to take place in 2023, you already don't have any damn money left over for disposable income. How in the hell are you going to be able to sell? I'm sorry, how in the hell are you going to be able to save enough money for a down payment to afford a home? And if that entry level market starts to dry up, that first time home buyer market, those folks that are in the middle that need those folks at the starter home to buy their home so they can move up, it's like a cog in the wheel. You see what I'm saying, ladies and gentlemen? The whole system just. Also keep in mind, back in 2008, when the federal funds rate started to get cut, we went into a massive deep depression. Lending standards are slowly starting to tighten. So don't be surprised if your temperature starts to rise when the Fed decides to raise interest rates, because as a result of that, it'll cost more to borrow. Lenders will be a little shy. They'll be risk off in that environment. And as a result of that, they're going to increase lending standards. So for an example, if you are eligible for an FHA mortgage, and let's say on the books, it says that FHA will do a mortgage at 580 FICO score, a 580 FICO score with 3.5% down. But you go to ABC Bank, and because the lending environment has tightened, they are not mandated to follow the 580 FICO score. That's just the minimum FICO score that FHA will insure the loan. The actual lending institution that loans that money out to you may have a significantly higher credit and lending standard before they issue you an FHA loan. So they may come back and say, hey, we're only doing FHA loans if you've got a 640 or 650 FICO score. And you might go to the lender and be like, well, wait a minute, I looked on the FHA guideline website and they said that you guys do 580. That's how low they're willing to endorse the loan for. Keep in mind, in the event that you default on an FHA mortgage, the insurance, the private mortgage insurance kicks in, so the lender can be made whole, but it's still ultimately up for the lender to set up their guidelines. So it's imperative that you pay your debt down and keep your credit score up, because lending requirements will tighten in the latter part of 2023. Here is the little slide that I wanted to share with you before we wrap up on this video. What 97% of the population does not do. And I didn't word that the right way. Sorry about that. So anyway, is your life drifting aimlessly about? This is what it is. Only 3% of the population sets goals and objectives. You can Google this. 97% of the population don't. So here's a simple test. If I was to reach out to you guys, I know this is a video pre-recorded, but if I was to reach out to you and say, can you come within $50 of telling me what your food bill is on a monthly basis for the last 90 days? I guarantee you probably 95% of you don't know. So a lot of us are complaining, moaning about food prices, duly noted, but you got to get a hold of your expenses. You got to set up a budget. You got to understand what's coming in your household and what's leaving your household. And food is a significant monthly obligation. Once again, setting aside your mortgage or your rent payment and then your car note, chances are your second biggest expense could be food. So you need to get a handle on that, figure out ways to stretch meals, figure out ways to increase your income and beat inflation. So I'm going to wrap this video up. I hope you enjoyed this information. If you are enjoying this content, please smash the like button before you click off. If you have not subscribed to my channel, I humbly request that you do so. And last but not least, keep your credit score up and your debt down. This was the Kevin Strong Show, and I'll see you guys